Hello again, and welcome to the second part of the update, focused on the macro view and the positioning. It has been a truly extraordinary month, and I believe this is set and formalized the transition into a new paradigm, which I think will be dominated from these efforts from too big to fail bubbles into inflation. So you'll hear me using this word quite a lot. Inflation is not currently in many people's radars, but it's clearly the end game of this new phase. So let's see how we got here, and I'll be discussing the overall contrarian thesis in more detail in the fourth video later. But many of you are already familiar with the concept of anti-bubble. They're familiar with the contrarian thesis. If you're not, please go through that video. But let's focus on the conclusions. And my view was that after a decade of monetary and fiscal without limits, the complacency and bullying of the central bank put, the complacent, desperate search for yield from investors, we had created global that where basically the damage was done. A decade that saw the risk, and where to me there were two extreme scenarios. I think whoever believed that we might exit that unscratched, I think was delusional. Of course, nobody could have anticipated the virus, but my view is that the damage was already done. So in that sense, these two scenarios, the first and most clear is what I would call a conventional crisis. Plenty of candidates, China, high yield, many other zombies, many others. And in that sense, perhaps a matter of when, not if, and unlikely or undesirable rather, very deflation scenario with these bubbles that are too big to fail. The other extreme was, okay, perhaps mommy and daddy, central banks and governments will be able to contain these bubbles from imploding, perhaps with monetary and fiscal without limits. But clearly printing money, spending debt, and what might be needed to do that would result into inflation as a problem, which is so these two extreme scenarios of deflation, inflation, which for some people might look very, very far away, is actually pretty close. It's more of a circle than a straight line. And in the framework, I highlighted another key risk, which was the possibility of the anti-bubbles actually pricking the bubbles. It's not just them falling by their own weight. It's some sort of event like a volatility shock. Could have been anything. Could have been a geopolitical shock. It could have been anything. But it happened to be the virus, which is obviously not only a huge volatility shock, but a much bigger shock in many other dimensions, something nobody could have imagined or envisaged. But I think it exposed the pre-existent fragility of the system. So in that sense, we have seen that event. It's actually led to this pretty major sell-off in markets and what's to come. And I think we're already well embarked in the response into the path to inflation. So, and amongst other consequences. So let's look at this second dimension. So the first one being damage is done. The second one is we've had this shock, which again, nobody could have predicted, an absolute terrible crisis. And it's actually a shock in multiple dimensions. First, and very importantly, as a volatility shock, as we saw in the previous section, we saw the VIX spike into levels not seen since 2008. But it's also, very importantly, also a demand shock. We've seen, myself included, and many of you in lockdown, major issues in employment to come, and major disruption to energy consumption and many other things, restaurants, etc. It is also a supply shock, and that this is becoming more apparent. Logistical change and potentially physical shortages if this was to persist. We added an energy crisis with ROPEC unable or unwilling to reach agreements that would cut production and take the hit. Hard to blame them. At the end of the day, this is a truly major sacrifice, and they need the money as much as anybody. So that OPEC put, which we challenged in my first book, is playing out again. I think people, it proved to be a lot more fragile than people thought. And let's not discuss even the healthcare crisis, the confidence crisis, and what it means for political systems, which is a different story, but very much related to also how governments and central banks are colluding to address this extraordinary crisis. The third pillar is, whilst we've seen, perhaps the damage was done, bubbles without precedents, and a shock without precedents, we're also seeing response without precedents. The speed at which the Fed and other central banks have responded is way faster than 2008. We've seen pretty much everything thrown in, including not only in volumes, in time, in quantity, in different measures, buying credit, repo lines, swap lines, doing absolutely everything possible to try to prevent this from the total and utter implosion, which could lead to a depression. And the jury is out to what extent these measures will be able to contain that. But certainly we cannot ignore the impact of these measures, and on the positive side with stabilization and medium long term with other consequences. It's the first time we see this fiscal response hand to hand in such a way that I would argue that MMT, modern monetary theory, is very much here. We are printing money that is being given to the government, that is being lent or spent, and that we can safely conclude that, in my view, it won't result in increases in taxes necessarily, and very likely will be monetized. Effectively, will never be paid back, which is highly inflationary. So I made this point on Twitter that inflation is not really about asset values going up. It's really about the value of the money that we use to buy those assets that is going down. It's that dilution of money that presents big challenges, and I'll talk about this later, starting with cash, which you look great in the short term, but it's going to be a problem long term because the purchase power is very quickly eroded, or bonds that will give you some money back, a fixed amount, which it's questionable how much it will buy you in a highly inflationary scenario. So not a pretty picture for cash and bonds over the medium long term. So when we look at the three pieces, this is like tectonic plates that are clashing. You have damage that's already been done in a huge scale. This has zombies, a term used for companies or governments that are dead, but they look alive. They've been effectively kept alive by artificial cheap money, whether it's zero or negative interest rates or some sort of help. We've seen also lots of damage done through artificial low interest rates, things like equity buybacks. We see airlines having bought back the region of 25 billion over the last 10 years with big bonuses for the CEOs, and now calling for bailouts, which is creating a lot of uproar, rightly so. So that's a big problem, and lots of ways in which we had a lot of hidden leverage in the system with these artificial low rates. Then we have this shock without precedents, which obviously leads to a lot of volatility. The jury's out. I sent a Twitter this morning asking people two questions. What do you think about the recovery in terms of the economic recovery on the one hand, and the markets on the other, because I think we need to differentiate between them. Is this a V, a very quick back to all-time highs, or normal? Is it a U? Is it some kind of WM, which is all over the place with lots of dispersion between countries and markets and volatility? Or is it an L, you know, where things collapse and we stay down forever? But nobody, or for a long time, nobody really knows. That question on or how long and how high, it's in everybody's minds. And obviously, what we've seen is the initial optimism of the market that this would be a very quick V is becoming more real with unemployment numbers today, over 6 million in the US, close to 10 million in the last 2 weeks, pretty much unprecedented. So the piece of the response is also huge. I mean, so these three pieces have enormous implications, risks and opportunities for investors. I mentioned a few already, and I'll elaborate further. But as we look through these three forces, at the end of the day, our portfolio is designed to, as we saw in the previous video, in a very conservative way, with no leverage, with core positions in assets that we believe can and will perform strongly into this scenario of money printing and debt and low interest rates and volatility. And I highlight particularly the role of the options. I think gold will be a very, very strong asset. Treasuries have room to go, albeit limited. But the option profile, I think it's something that will continue to provide the asymmetry, which is even more needed now than before, as some of the fixed income instruments lose convexity. They become less and less punchy. So looking again at the kind of option profile and some of the positions and the views, I'm going to zoom into some of these, and I'll start perhaps with one of our core views, which is gold. And this is something, you know, you see there the article I published in the front page of the FT. It was called Gold's Perfect Storm. It led the way later to the book, where I framed the concept of anti-bubble, where I coined the concept and put forward the framework. And I was already then talking about 3,000 to 5,000 gold in the next 3 to 5 years. It was considered to be science fiction, I guess, for a lot of people, less so these days. And what we've seen is the thesis not only has survived, it's actually been reinforced, unfortunately. Unfortunately, because it's really not the right path, and we seem to be doubling and tripling the bets. So very importantly, at the end of the day, you can't print gold, but you can't print any real asset for that matter. So whether it's land or real estate or other assets, I think this is supportive. We need to differentiate between assets that are more levered or less, or with debt attached to them. But certainly, you can print gold, unlike dollars or euros or treasuries, or Apple shares, which you can. I think this is a long-term process. If currency wars was a marathon, I think gold will beat everybody, hands down. It's very obvious to me who will be the big losers. Clearly, what I would call the printer currencies, which there's the usual suspects in emerging markets, whether it's Brazil, South Africa, China, or others. But you also have some developed market guys, and to be honest, nobody's really out of this game. Everybody's doing it. It's a relative game. But I think in despite everything that the US is doing, I think the dollar will continue to prevail, and as probably definitely podium in this long-term race, but possibly second place behind gold. In a world of zero or negative rates, gold becomes much more interesting. In fact, we started to see tightness in the market, with tightness in the futures, steep backwardations. This is something not quite unprecedented for gold or precious metals, but certainly unusual. you can attribute it to logistical bottlenecks, but there might be some real tightness behind the scenes, which is extraordinarily bullish. Unlike bonds, gold is much more symmetric, is much more uncapped. I think that idea of the limited upside of bonds will become a bigger issue as we approach zero, which I think we will. And you know, the combination of volatility and correlation, combining bets like gold and the dollar, gives us extraordinarily, in my view, artificially cheap insurance, which we continue to monetize. A lot of people worry about deflation. So do I, if there was this major implosion. However, let's not forget the end game. The end game here is inflation, and that's coming probably as part of stagflation and with other forces. But at the end of the day, inflation is a monetary process, and all the money printing is diluting the value of that paper currency. So inflation is coming, yes or yes, whether it's trying to offset overcapacity or gross misallocation of capital or gross permanent destruction of capital, it's inflationary. So I think that is something, don't get fooled by that. I think clearly currency and trade wars will remain and will accelerate. This is obviously a race to the bottom, and I think it will accentuate the role of gold and others. We've seen a major cleanup, as we'll see in the next section. Truly a massive clean of positioning, specs, futures. Many people have been taken out of any levered positions. So I would argue that it's much cleaner, which potentially clears the way for further upside quicker. It could move much faster, having removed a lot of that. And I do believe that despite the price action, which is reflective of the surge in volatility, gold will continue to be a reliable and appreciated safe haven for the key risks, being inflation, you know, money printing and bubbles. So our view on gold remains very strong. We prefer gold to equity miners. The risk of too large. You know, taxation, expropriation, nationalization. So that might be less clear on a low gold price environment, but as stress increases, I think the basis between gold and the equities will increase. So mind that. But overall, a very constructive long-term picture, but it will be bumpy. Let me elaborate on a second position, which is a review on China and the yuan. This is also very core. And here, you know, I've been discussing this for a long time. In fact, it's my Lehman squared in the book. This is probably the biggest bubble in financial history, which is yet to play out. And I was just another recent Twitter, you know, where China has been injecting money into the banking sector. And the headline read, China injects $7 billion, which I corrected because they don't inject dollars, they inject yuan. So they can print yuan, they can print dollars. So this is pretty much the norm with all the people. The Fed can print dollars, everybody else can print their own currency, but nobody can print gold. But basically in China we have a situation where it's a country that is, I would describe as semi-open, which means it's also semi-closed. They kind of trade with the world, but they do it with lots of rigidities, whether it is you know, through the exchange rate or other controls. And every time they find themselves in trouble, they do the same formula, which is kind of print, lend, spend, and bail out, which is basically more printing. They want to give the perception of being very strong and very rigid, which to me is fragility. If you think about a skyscraper in Japan, you know, they're not made out of concrete. They're not sturdy. They are actually supple and flexible. So I think when this crisis come, you know, this perception of rigidity actually is very false. So careful with that. Obviously, the central planning has led to massive overcapacity. which is deflationary for the world and an issue of contention. But at the end of the day, all the money that is being printed in the system that cannot exit because of the currency controls, like water, sort of flows into pockets. And there's been a couple of them that are pretty major, which is real estate and infrastructure. Overall, within the overall credit, these bubbles are, no question, in my view, too big to fail. They're just, if my numbers are correct, only about 3% of the wealth of Chinese people is in equities. Their money is really into brick and mortar and their own businesses. And these bubbles are, with ghost cities and everything else, and roundabouts in the middle of nowhere and airports and whatever. Very reminiscent of my own country, Spain, in 2007, with the difference that in Spain, eventually this thing collapsed. In China, these things are just too big to fail. I cannot think of a scenario where you actually see the chain of developers, real estate prices going down, mortgages, collateral, asset liability in the bank, wealth effect, lending, etc. So this is something that is not going to happen. It's not going to happen not because those house values shouldn't fall. It's not going to happen because they will print infinite amount of yuan to prevent those values from coming down. But the fact that that house is still worth $1 million yuan doesn't mean it's still worth the same amount of euros or dollars or yen. So clearly, the degree of freedom in the system is a gross devaluation. Currency wars are very prevalent. Is a trade-off that has been calculated. The trade-off between inflation and bubbles and creating jobs and exports and taking technology and other things from the rest of the world. I think this has already changed, but it will continue. And this is why trade wars is kind of checkmate and game over for China, because if you start putting these tariffs, they're left with inflation and the bubbles, but they lose their edge on jobs and exports, and which would be brutal. So unlikely that anybody wants that to happen, but obviously China will suffer the most, and that's why I think the devaluation is pretty much unavoidable, no matter when, not if. Interestingly enough, despite the coronavirus being, the epicenter is China, China and the Hong Kong dollar are amongst the best performing currencies in the world this year. And this is somewhat surprising at first, but certainly it creates a big problem for China, because now they're 20% more expensive than Brazil than just a month ago, or than South Africa or a number of others. So even if you just see China as one more emerging market, you should expect that devaluation to follow, and there's quite a lot of room to go, not only because they have the biggest problem, but also just purely from a lagging effect, short of the dollars and many other things. What's ironic is that despite all these issues, insurance is grossly artificially cheap, both in terms of volatility and correlations, which is why, when we look at the positions, it's one of our core views. It's a major risk that people are neglecting, but I think it will become more prevalent over time, and these artificially cheap options can pay a very meaningful amount, just like the S&P puts or the VIX calls that everybody disregarded could do. So you want to accumulate this insurance while you can. The time is now, and we feel very strongly about these positions. I will elaborate further, and I already touched on why we think dollar rates will stay low, why volatility will remain high, why we think asset prices will stay under a lot of pressure, particularly as we see economic data coming through, and why we have this contrarian view, or somewhat contrarian on the dollar. I will conclude this section 2, and for those interested, which is really about portfolio construction. It's about the team. It's about the role of the goalkeepers in these portfolios. Thank you.